All right, so you've done it, you've put in the work, you've invested your money, and it's happening. Your investment is actually growing. It's an amazing feeling, right? But hold on. As those profits start to stack up, there's something else you need to know. A little detail you might have totally missed.
I mean, that's the dream, isn't it? Making money in your sleep. But as you're watching those numbers go up, 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 have you ever stopped to think, are you really alone in this?
Well, the short answer, no. Turns out, in the world of investing, you actually have an invisible partner. Yeah, someone who gets a piece of your profits, but here's the kicker. They never put in a single penny to begin with.
Okay, so let's pull back the curtain and see who this mystery partner is. It's the government, and their cut is what we call the capital gains tax. Now, I know, tax can be an intimidating word, but honestly, thinking about it like a simple partnership makes this whole thing way easier to get your head around.
So what exactly is a capital gain? It's really simple. It's just the profit you make when you sell something like a stock for more than you paid for it. And the capital gains tax, that's your partner's share of just that profit. This is super important. The tax doesn't touch your original investment, not a dime. It only applies to the new money your money made.
And that's why silent partner is the perfect way to describe it. Think about it. They're not there with you when you're up late researching stocks or when you're stressing out over a market dip. But when you win, oh, they show up, quietly, ready to collect their piece of the action.
Now, any good partnership has an agreement, right? A set of rules. And this one's no different. So let's get into the terms of the deal, because how this tax works is completely different from the tax you see taken out of your regular paycheck.
Okay, so here's the big difference you need to understand. Your income tax, that's a tax on the money you earn from your job, your labor. But capital gains tax, that's a tax on the money your money earns for you. It's a totally different ballgame. And a really important part of this whole partnership agreement is time. If you hold an investment for less than a year, your profit gets taxed at a pretty high rate, kind of like your normal income. But if you hold it for more than a year, you can qualify for a much, much lower long-term rate. And trust me, that's a detail that smart investors pay a lot of attention to.
All right, so this brings us to the big question. How do they even figure out what their share is? Well, the good news is it's not as complicated as it sounds. Let's just walk through a really simple example so you can see exactly how it works.
Okay, let's say you invest $1,000 into a stock. That's your initial investment, right? The money you put in. Right now, your silent partner has zero claim to any of this. It is 100% yours.
Okay, let's jump forward in time. Your investment did great. You decide to sell and you get $1,500 back. Awesome, right? You made money. But we're not quite done yet.
Because this is the number your invisible partner actually cares about. That $500 in profit. That's your capital gain. And their share? It's calculated only on that $500, not the whole $1,500. Your original $1,000 comes right back to you totally untouched. That's key.
Okay, so we've covered what it is and how it's calculated. But the real question is, why does any of this matter? Like, what's the actual impact on your investment growth? Let's take a look. Because this is where people get into trouble. You see that $500 profit and you think, great, I have $500 extra, and you start planning what to do with it. But if you forget about your partner's share, you are setting yourself up for a really nasty surprise when tax time rolls around. You have to see the whole picture.
So look at it like this. You've got your gross profit, that's the whole chunk of money you made. But then you have your net profit, and that's the money you actually get to keep in your pocket after your partner takes their slice. Forgetting about that second number, it's a mistake a lot of people make.
So let's just boil this down to the three most important things to remember. Number one, your original investment is always safe. The tax is only on the profits. Number two, if you ignore your partner, you're going to get hit with a surprise tax bill. No fun. And number three, the smartest investors always plan for their partner's cut right from the get-go.
Look, just knowing you have this partner is the first step. The next step is figuring out how to manage that relationship. Learning the strategies to make sure their take is as small, as legally and ethically possible. We're going to be diving into all of that in future explainers, so if you want to learn how to keep more of your hard-earned gains, you want to hit that subscribe button.
So I'll leave you with this question to think about. Now that you know you are not investing alone, now that you understand the basic rules of this partnership, how is that going to change the way you think about your investments? It's a really important question for every single investor to ask themselves. Thanks so much for tuning in.